Well, some big market energy came in on Friday's close where we saw the S&P 500 get hit with some sell-side activity. However, we have not seen anything yet. In today's video, I'm going to be giving a snapshot into what we saw in the market. We're going to be diving into some shorter term timeframes, but we got to look at some of the big picture charts that I've shared in the past, including this one, and many, many more. We're going to dive into market conditions, expected moves, and talk about what's on deck for the week ahead. If you don't know by now, this is the Stock Market Brief Show where we navigate the financial markets through the lens of technical and intermarket analysis. We look at big picture stuff and try to hone in on the day-to-day. Let's get into today's show. All right, ladies and gentlemen, welcome back. Before we get into the chart deck, got to thank my partners, Interactive Brokers. If you haven't seen them, click the little link in the description. Check out their interactive campus, which has a bunch of free resources and tools. And most importantly, over here as well, got to thank my patrons that support this channel. We're going to start off today's episode with the snapshot of the market. We got some sell-side activity on Friday, We've been talking about the possibility for a bull trap, We talked about the Bollinger Bands. They were getting very tight, Well, guess what? Well, the market started to move. And where did it move to? Well, we saw a little breakout to all-time highs, at least in the S&P 500. And then we saw the Bollinger Bands contract, and we saw the market see some volatility on Friday on option expiration. And where did we come to on ES? Well, we came right down to the year-to-date anchored volume weighted average price, right back into the trading range that we've been trading in for quite some time. In fact, here's some interesting stuff. What you see on the screen is the SPY, the S&P 500 Spiders ETF. And what you'll see are these orange lines, right? These orange lines are what the market priced in for the week ahead, what the expected move was. So right out of the gate, I want to just point out, right now, going into next week, we have about $11, this week on Monday, $11.26 expected move. Now, if you look back all the way to 2025, that's bigger than every single week except for this one right over here. So we're looking at one of the largest implied weeks. Now, that's very interesting, and we'll talk about why that might be. But a lot of people might say, well, NVIDIA earnings. Well, guess what? We had other weeks just recently where we had Google, we had Meta, right? We had all kinds of big earnings going on. So we have ourselves some very, very large moves. Now, what's even interesting, more interesting about that is since 2025, since the start, we've tagged the weekly expected move every single week and exceeded it in some. In fact, 4 of these weeks, we've actually closed outside of the weekly expected move. So the market has been rather efficient in pricing in and handicapping risk. However, in some weeks, we're closing just outside of it. So when we see an $11.26 expected move, there is a high probability that we are going for one of those levels and potentially even more. Now, another cool, interesting tidbit here is the market for the last 5 weeks, right? Here's 1, here's 2, here's 3, here's 4, and here's 5. The last 5 weeks, look at the Fridays. Okay, let's draw little arrows. Here's Friday 1, Friday 2, Friday 3, Friday 4, and Friday 5. What do you notice? Every single Friday for the last 5 weeks in the red. And 3 of those Fridays, this one, and this one, were all considered distribution days. So as price has been going sideways, chopping back and forth in a very, very tight range, we are seeing some distribution take effect. And that is not necessarily a good sign for the markets. It doesn't mean, hey, short the market to all oblivion. We're going down. It's going to crash. It's going to be 1929. That's not what I'm saying here. What I'm saying is the market's going through a little bit of a period that can be a period of distribution that can have the effect of heading to a decline. However, when we take a look at this chart, we can go all the way down to 5,900 here, and guess what that means? It literally means nothing. It means that we're just back to this range low that we've been kind of trading at. So until we really substantially break some of these levels here is when we can say, okay, either buckle up or, well, actually buckle up. It could be buckle up to the downside or buckle up to the upside, because once we get an official break, we can see some massive, massive moves, directional moves in this market. Now, let's talk about seasonality, because this is a chart of VIX seasonality. And guess what? We are creeping into A volatile time of the year. As you can see, we've been kind of tracing this volatility. The white line is current. The dark shaded blue line over here is the seasonality. And we're kind of moving into this period where we see volatility spikes. In fact, if you look at the S&P 500 seasonal volatility, it's been tracking fairly well. And we're kind of moving through this seasonal week period. Does that mean it has to follow? No, it's just something to be cautious of and aware of. You can't really make trades based off of seasonality all too much. You need price to confirm because price is the only thing that actually matters in the grand scheme of things. Now, I do want to call out that I do find it interesting that we are moving into a seasonally volatile period. And this is happening as we've slipped into negative gamma. This is a history chart, net gamma history chart. So when we are this blue shaded area down here, it means we're under that gamma flip line, which we talk so much about here at this channel. It's part of the market conditions, which we'll get into. And then when you're the white line up here, it means you're in positive gamma. And this really is very important to watch this because it determines really the conditions of how dealers act, how hedging activity takes place. And to make it very simple, when you see these things change, it can tell you whether to be more bullish, more bearish, more aggressive, less aggressive, and etc. So we did slip into negative gamma territory. And let me just show you just how interesting this is. I want you to pay attention to the times that we see these darker blue bars. I painted them on the VIX, right? This is the VIX chart. Or I'm just using the VIX. I'm not using VIX futures right here. I'll show you VIX futures curve in a minute. But the gray shaded areas are the areas where we slipped into negative gamma territory. And when you see that, what do you notice happens shortly thereafter with the VIX? Boom, you see rises in the volatility index. And you can see over here, we kind of went in and out multiple times, including way down over here, which just occurred, okay? Now, if I want to zoom in even further on on Friday's price action and look at the minute time frame, you can see this was the 21st over here. We kind of came down. The gamma flip line was right over around here. We kind of doodled around it, and then we substantially broke right at about 9:10 a.m. That's Pacific Standard Time, and we started breaking down. Now, when you fall under this gamma flip line, this is where you'll get dealers to sell into selling, so you can get more volatile moves to the downside, but you'll also see them buy into buying, and you'll get volatile moves to the upside. This is where volatility typically increases, and look at what happened to the VIX that exact time at 9:10 Pacific Standard Time to the VIX when we started substantially breaking down through that. Well, look at the VIX. It took off like a rocket ship for the day. So yes, it is important to watch this. I've shown it many times. I've highlighted it until that changes, right? I mean, that's what we're currently seeing. Now, I do want to call out something that I found interesting, and that is the VIX futures curve. Now, if you don't know about backwardation and contango, throw that aside, not a big deal. What we're seeing here is the March contract, the April, the May, the June, July, all the way out there to October. And this right here is the VIX, okay, the volatility futures. You got 17.8% all the way to 20%. Now, in short, this chart right here, when it slopes from the bottom left to the upper right, this is what you want to see. This is not anything to be afraid of. This is the market saying, hey, we see a higher VIX into the future. Now, the time where you want to be significantly more cautious is when this line is sloping from the upper left to the lower right. Why? Because it tells us that, hey, we got stuff going on right now, and we see this we see it easier out into the future. So as I see this right now, when I see the VIX, and this could change, but what I'm seeing right now in the futures curve is simply this. This ain't anything yet, right? It's nothing to be really concerned of at the current moment. We're seeing some volatility, big whoop. If we take a look at back month versus front month volatility, we did get above that 20% over here. And what did we do in the market? Well, we kind of went sideways to down, and now we're kind of coming off a bit. So when we slip down back into these areas, this 1.0, where this is, once again, back month versus front month, so 3-month volatility versus VIX. You can make this chart yourself, VXV over VIX. When we slip down into these areas, the market tends to find some sort of bottoming activity or consolidation activity. When we get back month about 20% higher, that 1.2 reading, that can mark pauses in the market, things, digestion, maybe potentially some pullbacks, and etc. So this right here is just kind of telling us we're not getting a significant reading by any means in either direction, but it does suggest that, hey, we could potentially head lower. And when it gets down to these areas, we can start to anticipate a market short-term bottom, digestion, bounce, etc. Okay. So that's what we got going on in these markets right now. That was the shorter term. Let's take a look at the big picture. Now, this is a chart that I like to share pretty frequently just to give people a bird's eye view, right? From way up above and looking down. And I find this to be just one of the more interesting charts because we got the S&P 500 over here. And there's been multiple times, this is the monthly time frame, multiple times through history, everything's going fine. We're at new all-time highs. This time is different. And then we go into some sort of crazy event, right? Something that happens, triggers volatility, etc. Boom, blows up, recession, whatever the case. And then you go over here, we're recovering, there's nothing to be, this time is different than this time. New highs, everything's on, boom, financial crisis. Okay. Over here, right? It's all kinds of weird, crazy volatility over in this area over here, leading into the pandemic. Okay. And then right now, where are we? We're at all-time highs. Nothing to worry about. This time is different. Now, what has been similarity between all these times? Okay, about all these booms, etc. Well, if you look at the federal funds rate over here, so the Fed rate, and you look at the yield curve, you can put the 10-year 3-month, which is considered the quote-unquote Fed staple, or you can use the 10-year 2-year, which is more commonly tracked. Okay, I put the 10-year 3-month. But what you'll notice here is when it goes under zero, that means we have a yield curve inversion. A yield curve inversion has been known as it's predicted every recession, right? And when we have an inverted yield curve and we start to uninvert, there's always been a recession thereafter. Timing it, very difficult to do. However, if you just look on this chart, hey, we had a yield curve inversion. It started uninverting. The yield curve started to steepen. Okay. Uninverted steepen. Oh, guess what? We went through all these problems. Even over here in 2019 to 2022, we saw that volatility and that pandemic, which we can call it a one-off, call it whatever you want. It's still the case that it did happen, okay? Now, look over here. We're at new all-time highs, just like prior times, and we began to uninvert the yield curve just ever so recently. In fact, if you look at this yield curve inversion, this is the deepest, one of the deepest in history and the longest yield curve inversion. And we are just now kind of getting out of that area. And you can see, I even did over here, right? Over here, we uninverted, and there shortly thereafter, right? Why isn't this working here? Even there shortly after that we uninverted, the market still ended up going up higher for quite some time. Remember, these are monthly candles. So we went sideways for a while, and then we went down, saw a little bit of volatility. We saw it bounce back and then so forth. Now, another element here is the Fed rate, right? So during each of these times, what do we see the Fed doing? We saw them raising rates, then pausing, and then cutting. Raising rates, pausing, then cutting. Now, typically, people say when you cut rates, it's a good thing for the markets. And to an extent, that could be correct. However, looking back through history, when we get a yield curve to uninvert and they begin their rate cutting cycle, there has been an event that causes the Fed to go right back into what it's always done and slam rates back down to stimulate the economy, to stimulate the markets, and try to protect us from the volatility that enters. So you can see that from over here in 2001, well, past 2001 and so forth, as they were cutting rates. In 2009, the great financial crisis, it was slammed to zero. And in the pandemic, bam, we slammed to zero. And now we have rates as high as they've been dating back to basically, well, I mean, if you ignore this area right over here, back to the financial crisis. And right now, what is the Fed saying? Well, we're trying to reduce inflation. Oh, well, okay. Inflation is kind of upticked, which probably is going to be coming off on the next report. But if we start to get inflation to cool off a bit, the Fed can potentially start to lower rates. What would cause them to, well, cut rates faster? Well, there would be some exogenous type of an event that catches the market by storm, whatever the case may be, and it could cause the Fed to step in once again, hardcore. Timing this, once again, is like, we don't know what's going to happen. Now, let's look at a more technical standpoint, right? Let's take a look at the weekly time frame. We'll date back to the 2022 bear market over here and also the pandemic over here. And what do you notice? So we have a couple of indicators. It tells us this is the RSI. and we have the MACD, right? Momentum oscillators. And well, when price goes higher, but yet these indicators diverge, it says, hey, the market's moving higher, but the internals are weakening. It's something to pay attention to. And you can see over here going into the pandemic, well, there was a divergence, right? The market kept on pressing, just doodling higher like nothing was a problem. And then boom, we see something hit the tape. But even into going 2021, going into 22, with the support of the Fed, right, there was many things going on from an intermarket standpoint, suggesting that, hey, something weird is going on right now, right? We saw oil like cranking higher, right? We saw various assets more supportive of safety. We saw defense names. So there was a lot of interesting things going on. And then what happened? Well, we saw these negative momentum divergences. Price started to come in. We get news about Ukraine, Russia. Boom, we start seeing volatility hit the tape. It wasn't until October, right, where inflation hit a massive peak of 9% there, and then the market started to turn around. So the market started to turn around when the market also received the hottest inflation data. So the market was front running that, hey, now inflation's going to be coming off. And we found our bottom. Now, during that time, guess what? We also saw a positive divergence. So the indicators here were telling us that, hey, there's internals are strengthening. Yeah, price is going lower, but our internals are actually strengthening. And we found ourselves finding a bottom. Now, what do we see here? Well, we see divergences, a divergence here in the MACD, RSI, price moved higher, and we're seeing it come off a little bit. Other than that, we're really trying to just going sideways. An interesting note here too is nobody's actually nobody of higher caliber, right, is actually saying, yeah, the S&P 500 is going to be lower on the year. I don't think any big bank, any big anything is really saying that. I was just at a thing in Vegas and Ed Yardini was there, and he is putting on a $7,000 price target on the SPX. And I know it sounds, whoa, 7,000, that's kind of crazy. Well, actually, I looked at the options chain, and the expected move would still allow for the S&P 500 to get there. It was at that time that I pulled it, it was about $950 of expectation still that the market would be totally fine with, is what it's pricing in. So you never know. I mean, we could be 900 points higher, but we can be 900 points lower. Now, I want to go into the IWM, because a lot of the times when rates come off, people say, well, that's beneficial of small caps. And I would agree, but let me show you a couple of charts first. This is the IWM. This is the monthly time frame, and I've been tracking this channel since a long time, right? So over here, you can see that we kind of had this exhaustion gap. We went above, and then we started to see a squeeze higher. Use that actually as the example of the bull trap. And we started to come back in over here. We're just in this channel. And what do you see? Well, going into this great financial crisis over here, we did see momentum diverging here on the monthly time frame. Even over here, we saw some momentum diverging. This is back into 2016, where we saw a lot of market volatility there too as well. And we had even a larger price momentum oscillator divergence that led into all types of volatility here from 2018, right? That was the period in time where we had that Christmas Eve massacre, even the financial crisis up in here too as well. And right now, what do you see? Well, look at this. I mean, price made new highs recently, right? Moved up higher. We have an RSI divergence. And then look at momentum on the price momentum oscillator. This thing, it looks just pathetic, right? We hit this high over here. It went pretty strong given the context of the Fed stepping in over here, giving us that big boost. And then the market went higher over here to new all-time highs, and this thing is starting to curl back around a pretty large divergence. So it doesn't need to play out to the downside, but it still is worth noting that, hey, it looks like crud on the monthly time frame right now. So we got some work to do, people. Now I want to overlay this with the federal funds rate and then also the 10-year 3-month like we did on this chart over here. And take a look. Well, we're in this channel. This is the weekly time frame. On a shorter term time frame, you can see over here, when did the market actually move up significantly? So right over here through this time and right over here through this big pump. Well, it happened to be when rates were low. So yeah, congratulations, you're correct. Small caps typically do good when the Fed rate is down there basically at 0, right? However, did it do good when the Fed was cutting rates over here? They were cutting rates, but the market was not going up. Oh my goodness. They were cutting rates over here, but was the market going anywhere? No, actually, it really wasn't going anywhere. It wasn't till significant Fed intervention, slamming these rates down to 0, is actually when the IWM did well. Now, look at where rates are right here. Look back to the left, right? And what have we been doing since they started raising rates, keeping them still and kind of moving down? Well, since this point, look up. We'll bring it back to around here. The IWM has not gone anywhere. Look at over here. Okay, when they started lifting rates over here, this area, right? What did the market do? It literally did nothing. It literally did nothing. It went up a little bit, down, and then down. Okay? Even when they were lifting here, what was it doing? It literally did absolutely nothing. Just a lot of chop until we get what? Some sort of volatility event. So look at the RVX. The RVX, you can see that, what was this doing? We kind of had an uptick in volatility, kind of got tight here. Then all of a sudden, when we slam rates down, it's why? Because we had this massive volatility event. Right, a big volatility event. And then look over here at the pandemic. Boom, massive volatility event, rates come down. Now we see volatility obviously contracting over here. You can even look at the 10-year 3-month curve. It was uninverting during that time, and then we hit a vol event, right? Uninverting during that time, boom, we hit a vol event and they cut. So when would realistically, could we say, okay, now is the time to go hard on IWM and small caps? Because they might still go higher. But what this chart would suggest, it's saying, hey, if we get a big volatility event and you see the RVX fire off to 60, 70-ish area, there's a high possibility that the Fed might be stepping in here soon to stabilize market conditions. And if they do, well, we got to see what they do exactly. Are they going to be pushing rates down, reacting that way? And if so, history would suggest that, hey, be prepared to hop into some of these small caps. We might be volatile right out of the gate, but history suggests that you can catch some significant moves in short periods of time. I like to show this chart here too as well. This is something more new that I shared. It's a combination of some stuff that I've always shared, but I'm looking at a couple different charts here. First and foremost, at the bottom of the chart, this is the SPX down here. No surprise. Okay. Stayed back to about the pandemic. Same time frames that we're kind of looking here. This right here is skew. Okay, skew, right? If you want to look up skew, just Google what skew is. If you want to know the exact calculation, blah, blah, blah. Here, let's make it very simple. When line go up, hedging activity increases, okay? More hedgers, but they might forecast, they might see something potentially going on with the market. It is not a timing mechanism. It is not a fear gauge. It is nothing like that, okay? So do not think that. However, when we do get to some significant levels, you can also look at the put to call ratio, and there has been some interesting things that I've noticed with this. First and foremost, what did I notice? Well, if you start to get some heavy sell side activity, you'll see the put to call ratio go into extreme fear. Boom, it'll fire off like a rocket ship. At the same time, what you'll see happen typically with skew is it's going to slip to a very low level where it's relatively been trading at, which means what? It means that the fear is pretty intense. They don't see the need necessarily for put protection or hedging activities. And this right here can be a sign of a market flushing out and finding some sort of a bottom. So look, we got over here at 1.3 on the put to call ratio. This is the 10-day moving average of the put to call ratio. And at that time, what did the skew do? It went down, slipped under 115. And where were we? We were coming right here towards the pandemic lows. So it's a very good tool for potentially gauging, which, by the way, when this is actually happening in real life, when it's actually happening, your mind and your mindset's going to feel completely different than it is as simple it is right here. So just understand that, because you'll have a day that it goes down again, boom, boom, and you'll be like, oh no, it's different this time, and then all of a sudden it rips faces off. All right, it happens. Over here, you get a 1.2 reading, pretty high reading on the 10-day moving average. And what was skew doing right there? Going into 2023, it was slipping under that 115 level. And what did we find here at the market? A higher low. It was finding itself a bottom in the market. Where are we now, and why is it important? Well, so the 10-day moving average slipped below 0.8. Okay, that's pretty darn low. And anytime that we're kind of floating around this area or sliding through 0.8 and even sliding back above 0.8, to me, this is considered a sell signal. And it's not that I'm going to be pushing the market on a sell side or anything crazy, but this is kind of something that I've talked about. However, when you're down here in these ranges on the 10-day put to call ratio, it's saying that, hey, things are really bullish here. So don't be shocked if all of a sudden the market sees some volatility to the downside, or it starts to come off a bit, starts to go sideways, which we are seeing, by the way. And we've been calling it since we've got down here, by the way. But what is the skew doing? Well, look at the skew. The skew just recently reached a brand new all-time high level. So there is some sort of idea that's kind of floating around that, hey, like there's got to be some sort of protection out here because there could be something that potentially happens. So it's making it much more expensive, right? Look at what skew is, right? Like once again, but right now we're reaching high levels on skew. And now what I want to talk about is let's go back through history and see, well, when's the last time that skew's been kind of elevated while the put to call ratio was reaching down to this 0.8 level? Well, okay, right here. Boom. Oh, that's interesting. We came down to the 0.8 after a steep decrease over there in the 10-day moving average, and we're at about 155, which is an elevated level, right? And what happened? The market actually started going through that bear market. Over here, right? There was massive amounts of times that we were kind of underneath this pretty exaggerated level. And you can see the market, the market kept on going higher. Well, guess what? The difference here is the Fed stepped in with a bazooka, with a complete cannon in 2020, 2021. We saw the market really start to get going. But even times where we got to these extended levels and we started to see it slip back up and slip back up and slip back up, this right here was some massive volatility in the S&P 500 multiple times. So it was not an easy one-way ticket up if you were not quite aware. And during these times, we also saw that elevated skew multiple times. So I like to bring this up because I just want to call out that yes, skew has been increasing. It's not a timing mechanism by any point. So don't think that it is, but it is telling us that, hey, people are reaching for protection, right? And as they're reaching for protection, well, the put to call ratio, when it's down this low, sentiment is pretty darn bullish. Okay, and where are we on the S&P 500? Well, we're seeing some volatility. Step in a bit here. Okay, it doesn't mean anything until it means something, right? So we're seeing the market kind of come off a bit. Let's look at current market conditions. As we've already stated, we've kind of slipped underneath the gamma flip line, which puts us into an area where the dealers can sell into selling, they buy into buying. Volatility typically increases. We've touched on that. The market ran up to where? The JPM short collar. It was basically just about there. I was thinking maybe we can push a little bit further. That's what I wanted to see, a real bull trap. Now this to me, this is still actually a bull trap. It got to new all-time highs, breaking out of a consolidation. Everyone was like, this is it. But if we slip right back down to 5,900, that for sure was like, that was the bull trap. There you go. As it stands right now, this is just a little bit of volatility. I'm not going to call this a bull trap because this might turn around and fly up here and then might come back down. That would be crazy, and that would piss a lot of people off. Let's be serious, okay? Market hasn't gone anywhere for 5 weeks. So first things first, I look at two things for market conditions, right? Whether I'm bullish or bearish, and it tells me whether or not I can add more exposure or I got to take my foot off the gas a little bit. So right out of the gate, being under the flip line, I got to take my foot off the gas a bit because we're going to see a lot more whipsaws. My strategy has to adapt, it has to change. So I'm a swing trader primarily. I like to play breakouts. When we slip in a negative gamma tutorial, you get a lot more fake outs, which by the way, if you don't follow me on Twitter, follow me there because what I've noticed and I called out is a lot of powerful earnings moves. They've been faded. And those are some of my favorite trades. So a lot of those where they saw a big move have all came back to where they typically break out. Which, by the way, if you haven't seen Roku, take a look at Roku because I'm considering that as potential play here in the near future. It saw a massive move and it came all the way back down. So we'll see how that kind of regulates itself. The next thing I look at is the direction of the 5-day moving average. And guess what? This is something that I learned from Brian Shannon, who I got to meet out there in Vegas as well. And this right here is just from a very shorter term perspective. But in short, when the direction of this shorter term moving average from an intraday time frame, right? These are 30-minute candles, okay? When we're below a declining 5-day moving average, either you can fight that yourself and try to find a bottom, or you can let the market do the work for you, the dirty work, and try to be on the right side of trend when it changes. That's what this is. So right now we're seeing red across the board except for XBI. It's kind of flat, but it is below the declining 5-day moving average, albeit these are still above some year-to-date VWAPs. The Qs, the SPY, and the semiconductors, all incredibly important there, okay? And so that's a positive sign. And we saw some significant selling. So to see a bounce right back up to 606, 608 in the SPY, totally normal. However, if that happens, just watch where the direction of the 5-day moving average is at that time, because sometimes you can pop above it and it's still declining, so it'll turn yellow and you can kind of undercut it and potentially see lower highs in the meantime. So you really do want to see a series of higher highs and higher lows to feel a little bit more confident that this is just a quick shakeout, getting some people out of their long positions for the market to actually open the doors up and move higher, which we have kind of seen. The market has been reaching higher, 6150, 6200. Okay, it has been reaching higher, but we also have been in a range and that 5,900 door is still open. Okay, let's look at the expected moves going into tomorrow's trading session and the weekly expected move for the SPY and the Qs. The upper level is 611.20. The lower level for the weekly implied move is 588.68. This is what the market's pricing in for the week. So remember, at the beginning of this video, we said what? We said that every week it's tagged so far. So to see a move the S&P 500, SPY move $11.26, yeah, it's probably pretty possible, right? Just based off of that. Doesn't mean it has to, right? Remember, these technically, right, 68, 70% of the time, it closes within the range. So even if it closed within this range, it would be still right. Moving to one of these levels, it would be acting as expected. Tomorrow, right, Monday, we got a daily implied zone for about, I'm just going to say 595. If you want these levels, put them on your chart. To 605 up here to the upside. I have some levels on the chart, some VWAPs. First and foremost, the purple line, that's not a VWAP. That's the 5-day moving average. It's starting to decline. We said that. The blue, that's the month to date. We are below the month to date, which is the February VWAP. And then over here is the year to date low, right? That is the year to date low VWAP. And we are currently below that. So the average buyer since the low of the year is actually underwater based off of time and volume. And then the red line is the year to date. S&P 500 still remains above that, almost short, like barely. So what is this telling us? It's telling us the average buyer right now for the entire year is basically even. And that's not a good sign. And we can see that in the price action. It's kind of going sideways. Now, if you're up on the year, congratulations, because you're doing better than average. Right? We're basically there. So that's positive. And then if you look at the last year closing price, we are still positive on the year for the S&P 500. So that's some of the risk levels going into this next week. The Qs, we have about a $12.63 expected move. All right, 538 to the upside, 513 to the downside. Screenshot this, put the levels on your screen if you want to know the expectations of what the market's going to do. Now, the Qs are still above its low, year-to-date low VWAP and year-to-date high, year-to-date VWAP as well. So we're down in these ranges. It's looking at about an expected move going into tomorrow's trading session, a low of about 518 to 520, a high about 533 to 531. If we start reclaiming this blue, right, start to watch this white one above us, we are still below that declining 5-day moving average. This is the year-to-date high right there, and this is the year-to-date low VWAP, the whites. Okay, once again, the blue is the month-to-date, and then the red is the year-to-date. So a lot of pretty interesting price action. I will like to say that when you do close at the lows of the trading session, it's pretty common to break those lows. But on a very, very wide swinging day, it's also pretty common to just have an inside trading day. So you gap up, it rips up, and then kind of just trade it within it. Personally, for me, I would like to see it gap down, because if it gaps down fast and hard, that could be a capitulatory move. So what you do is you look at the advanced decline line, let's say the S&P 100. If you have a full-out correlation move where everything is down on the day, that's what capitulation could look like. And then you want to see the market turn itself around, and that is what I like, because it really just scares everyone out of positions. Everyone sells, hit the tapes, boom, get out of the way, and then it rips. However, what's probably going to happen is we're probably going to see a gap up, and then it's going to doodle around, and people are going to be like, oh, it recovered. And then all of a sudden it's going to take out the low in a day or two. All right, that's that crap. So we'll see how the market kind of sets up. Don't be in a rush in this market. Be aware of these expected moves, what the market is expecting, because when you don't think it can sell off anymore and you're not aware, oh, it's going for it, right? Like on Friday, last Friday, it went for it. People didn't think it was going to hit, but it did. What's on deck? We got NVIDIA earnings this week after the close on Wednesday. That's the big one. Other than that, here's a big list of the various earnings plays. So be aware that they are hitting the tape. Planet Fitness over here, that actually been doing pretty good. KDP, Dr. Pepper, some consumer staples have been doing pretty good too. I'm not going to be playing any of these, but just know NVIDIA is going to move markets because it's one of the larger market cap names, right? Larger market cap name, and it's one of the higher implied volatilities all the time. So it matters. And then as far as important data dropping, you can see over here, we got some durable goods on Thursday. On Friday, we got some core PCE numbers. We got some Fed speakers too as well. This is the following week. And then it's month end, right? We're coming into end of February, right? And then we have a new month, March, to finish out Q1 and then start earnings back up again, baby. That's all I got for you in today's episode, everybody. Hope it helps out. I'll see you later.